He has said recently that the Fed shouldn't react to elevated inflation, even as it causes pains for Americans. Because, Neel, you've said it many times, it's going to prove temporary. But you know what we're hearing more and more, as Sherry and Heidi, my colleagues, were just discussing, former Fed officials, even some current Fed officials, being concerned not about overreacting, but about underreacting to this surge in inflation and the fact that maybe it won't be as temporary as you thought. How do you respond to that?
Well, we're all paying very close attention to the data, and the higher prices that we're seeing in the economy are real. These are real pain points for families that have to pay them. And so no one is making light of that at all. My main point is we shouldn't overreact to what is likely going to be a temporary factor. Let's just take the supply and demand one at a time. If it's a supply side and it's supply chains that have been disrupted because of the pandemic, barring some introduction of some new wave or some new strain of the virus, those supply chains should work themselves out, some taking longer than others. On the demand side, which many people have argued this is really about a demand shock, a lot of fiscal stimulus, we know the path of the fiscal stimulus. Fiscal stimulus provides a one-time boost, and then it tapers off, and it itself becomes a drag on the economy. So unless Congress passes a massive new spending package that's not paid for, there's nothing that I'm seeing in these fundamental factors that leads me to think that this is a long-term change in inflation or inflation expectations. We are seeing pressures that are real, but most of the evidence in my mind seems to be that they're going to be temporary, even though they are real and people are having to pay it. But the challenge is if we overreact by saying, let's just change the path of monetary policy to try to deal with a one-time effect, that could lead to a worse long-term outcome for the economy.
Well, the supply chain shortages, constraints, blockages, whatever you want to call them, they don't seem to be going away. If anything, they seem to have broadened. They seem to be lasting longer. What you see in the data, because many Fed officials, including the White House administration officials, are saying, no, this is inflation surge is a lot about the supply chain. But the problem, what makes you say in terms of data, not just a forecast, that it is getting better and it's going to get better?
Well, looking at, just give some examples. I mean, it really is very sector specific. So a year ago, you couldn't get toilet paper when you went to the grocery store. Now when I go to the grocery store, the shelves are full of toilet paper. Lumber prices skyrocketed. Lumber prices have now fallen back down to earth. I just read a report before I walked in here that Malaysian chip factories are now coming back online to try to supply auto companies. I also recently learned that all the major auto plants in America have restarted. I'm not suggesting that we're out of the woods yet, at all, but many of these sectors are working themselves out. Some are going to take longer than others.
How about demand? Larry Summers, a former Treasury Secretary, well-known economist, has been concerned for some time that the Fed is not going to move fast enough and is going to let inflation get so high that the Fed has to move way too fast to pull it back in. He's talking about things like, you've got demand-driven inflation, prices rising because of a strong economy, some people going back to work, and it's not just things like commodity prices, firmer housing prices in a hot market, and things like that, although they're contributing to it too. What is the risk that this doesn't go away, that it does become entrenched?
Well, this goes back to, I read Larry Summers put out a piece earlier today. It goes back to what's the economic theory that a one-time boost of fiscal spending, a one-time boost of demand, it leads to higher prices, yes. Does it lead to higher inflation, which means ongoing year after year after year, continuing price increases? I don't really understand the mechanism by which Larry Summers thinks that this one-time fiscal stimulus leads to a change in the path of inflation, unless he's saying, well, inflation expectations are going to become unanchored. The Federal Reserve is never going to allow that to happen. All of my colleagues and I are paying very close attention to the data. And if we thought that long-term inflation expectations were becoming unanchored, we would certainly adjust to make sure that that did not happen. If you look at long-term inflation expectations in market indicators, they are not looking like they are coming unanchored or very high at all. We're seeing a boost of inflation expectations over the next 1, 2, 3 years, maybe even out to 4 or 5 years, but that's really driven about the next couple of years. So we're paying very close attention to the data. I just again say, even if you believe it is purely demand driven, a one-time boost of fiscal stimulus
Okay.
Explain to me how that leads to long-term inflation.
Fair enough, because I think the question people are asking is far broader than fiscal stimulus. And when you talk about inflation expectations rising, they have risen for things like the New York Fed Inflation Expectation Survey, the University of Michigan Consumer Sentiment Survey. Their longer-term measures are rising as well. What about a change in behavior from this? Businesses for years, I can't raise prices because someone will have a lower price. That has changed. People wouldn't pay a higher price because they knew they could go to a discount store and find a lower one. That has changed too. People are willing to pay whatever they can to buy a car, for example. Is there a risk that the expectations are changing, that changes behavior, and the Fed has a longer-term inflation problem than they thought?
It's certainly possible. I don't want to rule it out and say it's impossible. Of course not. But remember, think about the economy that we came out of before the pandemic. For a decade, we were struggling with low inflation expectations, not just in America, in Europe, in Japan, in advanced economies all around the world. That was driven by things like demographics, technology development, low productivity, trade. Have our demographics changed because of the pandemic? No, if anything, they've gotten worse. And so, we're paying very close attention to the data, but I don't want to just believe that, Japan's low inflation problem, is that in the past now? They're never going to have to deal with that again? I find that hard to believe. And so the key here is, from my perspective as a central banker, is not to overreact. We want to pay attention to the data, we want to look at the evidence, and we want to make our adjustments prudently, not just overreact because Twitter is hyperventilating.
Well, again, I would suggest to you that it's a lot more than Twitter hyperventilating, although there is definitely a problem, a pain that people across the country are feeling. And when you look at the consumer sentiment survey from this Friday, Richard Curtin, I'm sure you know him and know of him. He's been doing this survey since 1976. Consumer sentiment fell to a 10-year low in early November. The statement he put out is because of the rising prices and the growing belief among consumers that no effective policies have yet been developed to reduce the damage from surging inflation. Again, someone who's watched this for a long time, an authority here. How do you respond to that? You don't see a problem?
No, I do see a problem. I mean, the higher prices are real. People are paying them. It is causing pain. There's no question about that. We're also seeing higher wage growth, especially for the lowest income Americans. Net of inflation, higher wage growth for the lowest income Americans. We still have 4 to 5 million Americans who are out of work who would have been working had there been no pandemic. So let's not lose sight of the fact that this pandemic has killed 700,000 Americans or more. We still have 4 to 5 million Americans who are out of work who otherwise would be working. There's a lot of pain there, too. So just to say, well, we just need to focus on inflation and ignore the labor market, that's only half of our mandate. And so we need to pay attention to both sides of this. People who are out of work, who would like to work, but they're afraid because of COVID, because of Delta, they're suffering too, and we cannot lose sight of them.
Well, let's take a look at the labor market, because I think it's another reason why people think this is an economy that is producing inflation and could produce more. For example, you mentioned the millions who still don't have work, but there are 11 million jobs that aren't filled right now partly because of those reasons you say, people don't want to go back to work. Record quit rate, another sign of a hot labor market. Jobless claims are now back nearly to pre-pandemic levels, and those were very, very low levels before. And you see wage pressures. So this is, I think, just another sign that the labor market is healing. It's made a lot of progress, and we're seeing pressures there that could persist and, again, get entrenched in expectations, entrenched in consumer behavior and business behavior.
Well, I've heard, since I've been at the Minneapolis Fed since 2016, year after year after year, I heard one thing from businesses: historic worker shortage, historic worker shortage. And you know what happened? They found more workers to hire, and the unemployment rate fell down to 3.5%, even though people said that was impossible. Labor force participation continued to climb. Employment to population ratio continued to climb. So I don't have a ton of sympathy when I hear businesses say they can't find workers. I know we're in a unique situation right now trying to come out of this pandemic. We still have 4 to 5 million people who ought to be working, who I believe will be working if we give them the chance. But we have to get control of the virus. In this discussion, Kathleen, we've spent almost no time talking about COVID. let's not lose sight of the fact that 700,000 Americans are dead.
Right.
A lot of people are still afraid of the virus. That is the biggest issue facing our economy and the global economy.
Well, I think, but there certainly has been a lot of improvement there, too, and more improvement expected despite the uncertainty over variants. But let's look at something Bill Dudley, former president of the New York Fed, said today. He thinks that the Fed, by starting the taper so slowly and not being able to finish by June, puts it in a position where it may have to speed up the taper. Let's listen.
The taper isn't going to be completed until June of next year on the current trajectory. That's a very slow path of removal of accommodation, given the economic information that we're seeing. So I think by locking themselves in this way, I think they've doubled down on being late.
He went on to say the inflation rate the Fed funds rate may end up a lot higher. The market's expecting 1.75%. He said it may end up at 3 to 4%. Is that a possibility? Is that a risk?
Well, I can't predict the future any better than Bill Dudley can. And, we'll see what the economy requires, and the Federal Reserve will adjust monetary policy to achieve our dual mandate, as we've all committed to doing. And so is the federal funds rate going to end up at 2% or 3%? I don't know, and neither does Bill Dudley. We'll have to see how things actually unfold. The one thing about this pandemic, every time it seems like we've got clarity, there are new wrinkles that get introduced and new surprises that come. Is the next 6 months going to unfold exactly like Bill Dudley thinks or exactly like I think? I doubt it. We're going to get a lot more information on both the demand side and the supply side over the next 2 to 3 quarters. That'll give us a lot more clarity on where the economy is headed and where monetary policy should be. I
want another quick question from you, though, on broad-based and inclusive employment. You mentioned that people are still out of work, et cetera, that employment goal versus this inflation worry everybody has. You said you're watching it very closely. How do you square that equation? How do you view that trade-off?
Well, we've said that we're going to take a balanced approach. If those two are in tension, so up until the pandemic hit and up until this current environment, there was no tension. There was still slack in the labor market, and we were undershooting our inflation target, which meant it was easy to say we need to take an accommodative stance. Now there appears to be intention because there are still 5 million Americans or so out of work, and we're seeing these higher prices. So that's why we have to read the data very carefully and not just take a snapshot of where we think it is right now, but where the economy is going to be over the next 1-2 years to try to adjust policy on that arc.
Are any chance you're going to be on board with 1 or 2 rate hikes in 2022? That's what the bond market's pricing in now, at least after they see the inflation numbers. Bond markets have been very volatile. The inflation jitters are hitting them, too. What about the possibility of more rate hikes, which you, up until now, have said probably not till 2024?
Again, I just got to watch the data. We're going to get a lot more data on the labor market and on inflation over the next 1, 2, 3 quarters while a taper is ongoing. That's going to provide us a lot more information about what the underlying dynamics are rather than some of these short-term movements.
Okay. Let me ask you about something very, in the very near term. Tomorrow, the 10th Racism in the Economy event sponsored by the Minneapolis Fed, along with the Boston Fed and the Atlanta Fed. Racism in the economy, looking at financial services. What's on the table?
Well, we want to, as we've talked about, the Fed has a maximum employment mandate, as many Americans as possible participating. We've had this series, this 10-part series, looking at racism, keeping people out of fully participating in the economy and really achieving maximum employment. This installment is looking at financial services. There are people who don't have access to banks, who don't have bank accounts, who have to turn to payday lenders. How do we break down these barriers so that people can be linked to the financial system, be able to take advantage of the products and services that make the economy function more equitably, and be able to fully contribute to the economy? So we're bringing on board experts from nonprofits, from academia, from the industry to try to shine a light on what are the barriers, what needs to change, how do we make the financial sector more inclusive?
When you look back against these past 9 conferences, what surprised you most about this whole broad issue of racism in the economy?
How much is there if we were just willing to open our eyes? People point things out to me now, and it was there the whole time if we had just been looking for it. And these structural barriers affect people who are excluded, but it actually affects the whole economy. When businesses are saying, we can't find workers, my gosh, it's a worker shortage, and then I go to another meeting in a low-income community where people don't have jobs, we need to break down those barriers because it'll actually be in businesses' interest and the economy's interests overall if we can put everybody back to work. And so it's there for the taking if we are willing to be honest about what we're seeing and make the changes that we need to make.
Some people say, well, this is great for the Fed to look at this, but there's not really much the Federal Reserve can actually do in terms of policy or taking steps. Do you see something? Do you see things, particularly when it comes to financial services, wealth, jobs, that the Fed could do, can do to make a difference?
Well, one example is the Community Reinvestment Act. The Fed, under Governor Brainerd's leadership, has taken a lead to reform the Community Reinvestment Act and modernize it, working with other regulators and how banks apply that into their communities that they serve. That's one example. Another just is understanding maximum employment. I mean, a year ago, the Federal Reserve adopted a new framework for how we approach monetary policy, and we said we're going to take a much broader view of what maximum employment means. Just looking at that headline unemployment rate, that gave us a misleading signal. That gave us the wrong signal in the last expansion, and there were a lot more workers out there who, it turns out, wanted to work. And if we understand that better, we're going to do a better job achieving our dual mandate, again, which is better for the economy as a whole.